welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, April 19th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we have mixed futures. We're showing a little bit of green on the Dow and the S&P and just slightly red on the Nasdaq. Of course, things can change over the course of the next couple hours. We'll have more and more companies reporting earnings later this morning, already some out. Some good and some not so good. We'll go over some of those a little bit later in the show. First, let me walk you through the agenda for today. So we're going to start off with the daily market recap, as we always do. Then jump into talking technically, seasonality, earnings spotlight, and we'll wrap up with the three you must see. Before we get into any of that, though, I do want to walk you over to earningsbeats.com. If you go over to earningsbeats.com, scroll down, we have a free newsletter. Always like to start the show off with this, make sure everybody is aware. All it takes is a name, email address. It's a 3 times a week newsletter. There's no credit card required. You can unsubscribe at any time. 2 paragraphs in a chart. So very quick read, easy read. And we like to get it out around 8:30 in the morning. So about an hour before the market opens. If you decide to take a trade on any of these candidates that we provide, of course, that's completely up to you. We are not registered investment advisors, so we don't recommend that you buy or sell any security. That's completely up to you. We do provide market guidance, research, and education, though, and this is part of it. We really enjoy our Earnings Beats Digest community. Many thousands and growing strong. We do have free events from time to time, and if you are registered on here, you will get room instructions to any of our free events. That's another side benefit of being a Earnings Beats Digest subscriber. Also want to mention later today, 5:30 Eastern, we will be hosting the draft of the model ETF portfolio. And anytime we fill out our portfolios, I refer to it as the draft, because in my mind, we have all the draft picks. We can pick anything we want. We can pick any of the ETFs to put into our model portfolio. We'll be discussing the reasons why we're picking what we're picking. We'll go through the themes. Of course, the market, very cautious, I think. We need to be cautious over the next few months, maybe next several months. And so that's certainly going to have an impact on how we structure this portfolio. We've done a great job with the portfolio here in the last quarter. Back at the end of December, I talked about the market getting off to a rough start. And when we had this draft of the model ETF portfolio back in January, we took those things into consideration, hedged, and while the S&P 500 is down more than 3% since January 19th, our portfolio is actually up about 1%. So we've outperformed the S&P 500 by about 4 percentage points selecting ETFs, and that's not easy to do. So if you'd like to join us for tonight, if you do trade ETFs or you just want to listen in on the themes, some of the things that we're looking at that we believe will outperform over the next 3 months, then you may want to check this out. This is a members only event, but the good news is we have a 30-day free trial. So if you're interested, when you go over to Earnings Beats, you'll see this. Go down here at the bottom. You can click here. You can start your 30-day trial subscription. Again, it's free. And we'll remind you before your 30 days is up, we're not just going to allow it to roll over into a paid membership. We will reach out to you before your membership expires to make sure that you want to continue. I don't know that too many services do that, but we want to make sure if you're a member of ours, we want to make sure you're enjoying the service and that it's intended. Anyhow, that's coming up tonight, 5:30 p.m. Eastern. Love to have you. And again, going over a lot of the problems in the market and areas where we think we can avoid some of those problems. Okay, daily market recap. Let's take a look at what happened yesterday. Dow Jones Industrial Average up down 40 points. The S&P 500 down about 1 point. Nasdaq down 19. Mid caps down 5. Small caps down 5. So honestly, from start to finish, or from finish the prior day to yesterday's finish, not a lot of change took place. Had a little bit of volatility during the day, but essentially came back and finished pretty close to break even on the day. Saw a little bit of relative weakness in the mid caps and small caps, but otherwise pretty much a sideways day yesterday. Energy was a leader, up 1.5%. No shock there. Financials up about 0.75% or 0.6%. Technology rose about 1/3 of 1%. Discretionary up 0.3%. The laggard yesterday was healthcare. Healthcare dropped a little over 1%. So healthcare, which had been a pretty good performer throughout most of March and into early April, you can see we've now pulled back and are right near that 20-day EMA. So looking for maybe a little bounce there in the healthcare group as we go forward. The 10-year Treasury yield, let's see, right now it's at 2.86. Well, that's where we closed yesterday. Currently showing it up 2 basis points to 2.88%. So we're getting off to a little bit of a rougher start, some selling going on in treasuries, sending the yield a little bit higher. And you can see we have just been on this stealth move to the upside. It's only been 5 or 6 weeks since we were at 170. Now we're at 286. Obviously, a lot of stuff being priced in to the market here. And I think there's probably some folks that are front running the Fed. The Fed's basically announced that they're going to be getting out of their, reducing their balance sheet. And as a result, I think you've got other folks selling ahead of the Fed. So it's just a lot of selling in treasuries. And when you're selling treasuries, treasury prices go down. Yields, which always move inversely 100% to prices are going down because of the selling. Yields are going up. So what this is telling us is that there is a mass exodus right now out of the bond market. Could be inflation related. It could be front running the Fed. I've had a couple of different emails now saying, hey, isn't this when you want to get into bonds? There's been a lot of selling, treasury prices dropping, yields going up. Why wouldn't you want to get in now? I think there's going to come a time. I think if you're looking 6 months to 12 months down the road, I think you probably would be okay. I believe yields are going to drop again, but I don't know that we're at the bottom. I mean, the Fed is already talking about how they have, they're going to be reducing their balance sheet. And if you remember, the reason why rates were so low in the first place is because the Fed was buying securities. They were artificially lowering interest rates. And so now I think what we're getting is the opposite effect. Now the Fed's saying they're going to get out of all these securities. So we're, in my opinion, in the short term, artificially sending yields higher. I think once we get past that, once we get past inflation worries and so forth, I think you're going to see the yields coming back down. I wouldn't be surprised to see us back down below 2%. But in the short term, I think yields could go up over 3, maybe 3.25. Who knows how high they're going to go? I think, probably going to be spooking the stock market, already is to some extent. But rates are still historically low. I mean, we go up 4%. That's still historically low. I'm going to be saying the same tune for a while, even if yields continue rising. These are still low rates. These are not the kind of rates that are going to kill the economy. The problem is the economy already has some other issues. We've got consumer sentiment issues. We've got technical issues. When folks start losing money in their retirement accounts, they start feeling worse about things. They see all this bad news. They stop spending money. So we're going to see, in my opinion, a recession. I'm fairly confident. It's hard to say when it'll hit. Stock market will bottom before the recession's over. I don't know if it'll bottom before the recession starts. We'll see. I mean, that could be a little iffy. But I believe we'll see a bottom sometime over the next 3 to 6 months. It's still very possible that we could have already seen the bottom. But the more I look at sentiment and some other issues, I really think we need one more leg lower. I'm going to talk about sentiment in just a minute. Anyhow, 10-year Treasury yield continues to be on the move to the upside. All right, talking technically, let's again look at the S&P. I like to follow the S&P because for me, it's the benchmark. So if I can figure out what's going on with the benchmark, I can try to figure out some ways, hopefully, to beat the benchmark. And that's what we'll be doing tonight with the Motto ETF portfolio selection, the draft. Anyhow, you can see the downtrend right here on the S&P 500 over the last few weeks. We've gone right back down through the 20, through the 50, and just doesn't have a very good look here. I've pointed out in recent sessions, and even before all of this began, this down leg, that this could be a longer term uptrend followed by an inverse left shoulder neckline, head, neckline, in inverse right shoulder. But you've got to confirm this pattern. You've got to execute this pattern, which means you got to get back up through 4630 to execute this before this right shoulder falls apart. I've seen some crazy things happen in the market, so I'm not going to rule it out. I just don't think that's what the market's going to do. I think, yeah, we have a bullish pattern. I don't think it's going to execute. I think we've got more weakness ahead. I think best case maybe is just go down and retest the February, March low eventually. I don't know if it's going to happen this week or next week or this month, but I would say over the course of the next 3 to 6 months from now through maybe September, maybe even into October, I wouldn't be surprised to see us at least at some point get down and test this low, if not take it out. Sentiment would suggest we're going to take it out. I mean, everybody's piled right back into calls again, like nothing ever happened. This move right here got everybody excited again. And it was like really nothing. All of this was for naught. If I pull up a longer term chart here and look at the weekly chart, actually, I'm going to pull up the weekly chart with sentiment. Let's take a look at the sentiment here. So here's a 10-year, actually it's a daily chart. Here's a 10-year daily chart of the S&P, and down here is the 5-day moving average of the equity only put call ratio. And the way you set this up on StockCharts is if you come down under indicators and you just select price, and then you put in $ CPCE, that's the ticker symbol for the equity only put call ratio. And then for style, it normally, if you just have auto or candlesticks or whatever, it's going to really make this very noisy. So what I did is I set it to invisible. So if I didn't have an overlay, it would not show anything. It would just be an invisible. There would be nothing there. But what it's showing is the overlay, and the overlay is the 5-day moving average, simple moving average. So that's what it's showing. So it just takes away all the choppiness and just kind of gives you a sense of the trend and where the extremes are. This bottom, this bottom, this bottom. Notice where the extremes are. You start getting up to about 0.9, 0.8, 0.9 on the 5-day moving average, you got something going. When we had this weakness in March, late February, you can see actually January created the most panic. That was up, 5-day moving average got to 0.67. Nowhere near any of these prior panic levels. And when we went to the next low, the 5-day moving average was dropping. And then, of course, we had a rally, and we went almost all the way back down to the lows again, 0.45. 0.45 during the post-pandemic era was kind of in line with some of these crazy bullish readings we had seen. But prior to the pandemic and this straight move back up, I want you to look over here and look for the 0.5 readings, because you know what? There weren't any, not one in 7 years. And now we've had all this selling and we have one rally and we're right back to 0.45. It's like everybody's jumping right back into calls, like market can't go back down. It's got to go up. So what's happening? Market's going down. That's what we've been seeing ever since we hit that 0.45 reading. When I look back at history, I look back to like, 2015, 2016 in this period, you can see on that first low, we got to about 0.85. And then the next low, we came down a little bit lower, and then we rallied, didn't get up to a new high, but just rallied back up. You see this dip coming all the way back down again. And then from there, look at what happened. The market rolled over and we had one more big low. And that's what ended up getting us up to this level where we could literally reset sentiment. We need people to be so bearish that they can't believe the market could possibly go higher. That's when we're going to bottom. Not when everybody's jumping into calls. It's when everybody feels like the only way to make money is to buy puts because they think the market can't go anywhere but down. We need something to really rattle investors. I hate to say it, but after 2 years of straight up, we need this consolidation. We need this selling. We need something like 2018 just to kind of reset everything. You can see this dip. Look here. We got up to about 0.77. Here we got up above 0.7 on this low. We started to rally and back down we came, got all the way back down to 0.6. And then on this last low, that's when everybody threw in the towel and said, okay, that was when the Fed said they were going to raise rates. Remember those days? Oh, wait a minute, they're saying it again. And they are going to raise. They did raise once. They're going to raise a couple more times probably. They're not going to raise 12. I'll be shocked if they raise 12. But anyway, this was very similar. The Fed was getting very hawkish. Everybody's like, all right, this is it. Trade war. This news is horrible. Market's going straight down. And then we printed a bottom when sentiment got to a certain point. And not only did we bottom, but we went from about 2,300, 2,200 up to 3,200. We went up close to 50%, a little over a year. I think the same thing's going to happen. I think history is going to repeat itself. I think we're going to struggle this summer, probably go down and at least test that prior low. I think we could go down below. Still think there's a reasonable chance that we go below that level. And if we do, and we get the sentiment, the fear really building, and we can get back up over 0.80, especially if we could get to 0.90, but over 0.80, I would be happy with. At that point, I would be jumping into the market. If you see this 5-day equity only put call ratio get up close to 0.80, start buying. That's just my opinion. But those levels in secular bull markets, you're either at a bottom or you're getting darn close. Now here, notice we didn't stop at 0.8. We didn't stop at 0.9. We went up all the way to 0.1. That was the pandemic. So that was a little bit crazy, but that was a pretty high level. Here we got to 0.9. So if you bought when you got to 0.8, probably would have had another couple of days of selling. Probably would have been painful for a couple of days. But when these bottoms hit, you come rallying back very quickly because the kitchen sink's being thrown in. You're capitulating, which means you're going to have a ton of buyers coming in right after that. So that's what one of the things I'll be looking for here. All right, let's talk a little bit about seasonality. So one group, the worst group yesterday was healthcare. And they moved just back below the 20 and the 50-day moving average, the XLV did. So I guess one question is, should we be getting into this group? Should we be getting out of this group? Well, I can tell you that looking back at the XLV relative to the S&P 500. So when you're doing seasonality, all you have to do is come up here, click on the seasonality, and then type in whatever it is you want to look at the seasonality for. And it'll bring up this chart. Well, let me just show you from scratch how I did this. So if you go into seasonality and you click on XLV, it'll come up seasonality of XLV. Notice it's not comparing it to anything. It's just whatever the XLV has done. The default period is 5 years. So what I do first, if I want to see on a relative basis what the seasonality is, because it might go up, but the S&P might go up more. So the XLV could be a relative underperformer in seasonality, or it could be a relative outperformer. Anyway, I put in the SPX, and then I drag this over for 10 years. That's basically how long this secular bull market's been going on. So I'm just looking at during this secular bull market, what has healthcare done relative to the S&P 500? Well, in the month of May, it's outperformed 90% of May's. So roughly, I guess this is 8 of the last 9 years because we haven't had May yet this year. So 8 of the last 9 years, it's outperformed the S&P 500. Here we are into our 10th April. 7 out of 10 Aprils, healthcare's outperformed. Average outperformance 2.1% in April, 1.7 in May, 1.6 in June, 3.5 in July. This is an upcoming sweet spot for healthcare, at least during this 10-year run, this 10-year secular bull market run. So could it fall apart this summer? Sure. I mean, anything's possible, but history is telling us that this is a pretty strong time for healthcare. So if I look at the medical equipment group relative to the S&P 500 over the last 10 years, look at May, June, and July. Significant probability of outperformance, at least based on the recent past. All of these months have outperformed the S&P by a pretty good margin. I mean, look across. The only other month that's anywhere in this ballpark is January. January's been the best month on average. July's been second, and May and June have been tied for third. So these are 3 of the 4 best months, and they're coming consecutively. Next 3 months, medical equipment. Medical supplies, look at May, June and July. June and July tail off a little bit, but look at the relative strength. If you add these up, that's 3 percentage points, May, June, and July. They average, outperforming the S&P 500. So not only do the healthcare stocks move higher, they tend to move higher, but these are 2 of the groups within healthcare that tend to do really well. So what I did is just went back and I pulled up like scooter reports, and under large caps, I just typed in medical supplies, and I looked down here at some of the various stocks. And one that I wanted to point out was Amerisource Bergen, ABC. This was one of the leaders. Cardinal Health, Henry Schein, blah, 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 going down the list. But I picked out Dexcom. And the reason I picked out Dexcom, I looked at these on a seasonality basis. And one thing I just liked about Dexcom is look at May and June and July. Now, this is relative to the S&P over the last 10 years. May's gone up 67% of the time. Dexcom has outperformed the S&P 500 during May. 100% every year during this bull market, Dexcom's outperformed the S&P 500. You can see May and June, 4.8 and 12.6. These are average outperformance for those 2 months. That's 17.4% average outperformance during May and June. And so I was like, okay, what's the chart looking like? And so here's Dexcom. It was in a downtrend. It looks like at the end of March, it started to break out of that downtrend. So far in April, it's pulled back a little bit. But I think this breakout level at 450, there's the 50-day moving average. Even though we're pulling back, that AD line is staying up fairly strong. I'm thinking this is a stock that maybe is being accumulated as we get ready to move into these strong months for the stock and for the group. So it's just one way to maybe start at the top and work your way down, looking at a group from a seasonal perspective and finding seasonal stocks that make sense, and then looking at the charts technically to see if entry points make sense. So hopefully, that makes some sense to you. All right, earnings spotlight. So JBHT, this is JB Hunt, they reported last night. And I was really anxious to see what they were going to report because something happened here in mid-March, and all the truckers, wasn't just JB Hunt, all the truckers just got hammered in late March and early April. And they've been stabilizing, or at least JB Hunt's been stabilizing here. And the stock is up. They reported last night, they beat 229 versus 191. I just saw the bottom line. I didn't see the top line. I don't know if they warned, but they are rallying a little bit in pre-market. They're up about 2% last check, back to about 175. So maybe we're going to get a run back to that 20-day. I think it's going to be very difficult, though, getting through 185. Got this gap resistance over here, 184. These prior lows right here, 184, 185. 20-day moving average, 183. That's going to be the key resistance. So short term, we could make a run. Now that earnings are out of the way, maybe a little relief rally off of this move to the downside. Just be careful, 183 to 185. All right, J&J reported this morning. They did warn going forward in 2022 on both revenues and profits. The stock, though, was only down about 0.5% when I looked earlier, pre-market. So these stocks are so strong right now that they can warn and still apparently not get hit much. I still would expect with that kind of news that maybe we'll meander back. I mean, we got like a quad top right here at about 173. And you can see the 50-day moving average now has moved above 172. So if we do see weakness, that's the area where I would expect to see money rotate back into Johnson & Johnson. Lockheed Martin, I was a little surprised with this report. Very strong looking chart, move up, nice little cup. Handle coming back. I'm thinking, okay, this is where, we're probably going to move back down into the mid 450s, get that 20-day test. Well, we're getting there a little quicker than I anticipated because we're down almost 3% in pre-market. Lockheed Martin came up short of revenues. They beat on their bottom line, but revenues came up short, and their guidance was a little bit under both revenue and earnings per share, slightly below expectations. These are stocks. I mean, we're looking at J&J and we're looking at Lockheed Martin. These are stocks that are actually performing well, and their guidance is not anything to write home about. I'm wondering what's going to happen when all these technology names start reporting, the big ones, and many of the consumer discretionary. I'm telling you, the signs I see are a recession ahead. You've got some of these major leaders in different groups now coming out saying that we're probably going to fall a little short of expectations. I don't know. Got one big report later this week, Netflix. I mean, on the chart, it looks horrible. I'm afraid to see what they might say. That'll be a first clue for us. And on the flip side, on the good side, you've got Tesla coming out later in the week, and Tesla's been a relative outperformer in autos and has held up better than many of the other growth names. So, Tesla could be another one to watch. I think they come out tomorrow with their earnings. Halliburton, give you one more. Halliburton came out, did beat. This is one that I talked about last night with our members. Or with our community members. Actually, it was a free event. It was a sneak preview of Q1 earnings. And Halliburton was one of those stocks I said, I'm convinced that they're going to beat when they report. Well, they reported this morning, they beat their revenues, they beat their earnings per share. EPS, they only beat by a penny, but they did beat. But the other thing I said and I warned about was maybe a buy on rumor, which is what we've been going through. Wall Street accumulating on the rumor that numbers are going to be good. And then the numbers were good, but sometimes you get a sell on news. So the stock is down about 2.25% last time I looked. I think the 20-day is interesting, but I think the 50-day is really interesting. So I like $36 to $38 on Halliburton if it gets down there over the coming. It doesn't have to happen today. It could be over the next few weeks. But now that the news is out, perhaps we get a little bit of a pullback. I think 36 to 38 would be a great area to accumulate Halliburton. Close back below the 50-day moving average, you'd have to reevaluate, decide, if that's more risk than you're willing to take, then you exit. But that's an area that I would expect that we will see buyers. All right, let's move on. There were a lot of other companies that reported, and a lot more will be reporting, but just wanted to point out some of the highlights. All right, let's wrap this up. First, we're going to start off with Schwab. Schwab broke down with its earnings, closed at its lowest level since back in October. I think you got to be very careful there. Volume trends have been weak. AD lines going down, relative strength dropping. I think you got to be really careful here. TSCO, this is Tractor Supply, been trying to break out, but now it's rolling back over and closed at its lowest level in about 6-7 weeks. Oh, this one really needs to get back up through its moving averages. I'd be careful there. And the last one, BNTX, BioNTech, moving back down and closing just below the 50-day and just below these recent lows. Be careful. We could see selling accelerate there. All right, that's it for me. Again, come on over to Earnings Beats. Love to have you join us. Come to our model ETF portfolio. The draft starts at 5:30 later today. Just follow this link right here, and you'll be able to sign up for a free 30-day trial. Would love to have you. Listen, everybody have a great day. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.